morning, everyone. Welcome to our Phillip Securities Research morning call for today. We have results for WeHer, Centurion, as well as China Aviation Oil. For technical analysis, we have for S&P 500. And as for macro and sector outlook, we have the Singapore Weekly as well as our Singapore Banking Monthly. So this is our usual disclaimer. The information provided is solely for education purposes and should not be considered as financial advice. Without further ado, I'll hand over time to Ivan to get started on WeHer. Thanks.
Yeah, hi. Thanks, Sid. I'll be presenting on WeHer's second half results. Our report is published this morning, titled as Construction and Worker Dorm Anchor Growth, because we do think that these two segments will be the main drivers in recurring revenue and PATMI. Yeah, next slide, please. Yeah, so for WeHer's second half revenue and adjusted PATMI, both of them exceeded our expectations at 114 and 138% of previous forecasts. As you can see on the table on the left-hand side, the first positive for WeHer is their worker dormitory segment revenue. It increased by 21% year-on-year. This is being driven by positive rental revisions and also contributions from their phase one opening of their Pioneer Lodge worker accommodations. So for the phase one opening, there's about 3,100 beds. So this added about 20% capacity to their worker dormitory portfolio. And actually, in fourth quarter of 2025 itself, there's also the phase two opening of the remaining 7,000 beds from Pioneer Lodge itself. So we do think that remaining for about 40% increase in bed capacity will drive revenue growth for 2026. Uh, for the second positive for WeHer is their construction revenue. Building construction revenue spiked up by 172% year-on-year, as you can see in the table. This is because there's higher recognition of external projects. Now, almost all of their entire 600 million order book is made out of external projects. And this 600 plus million order book is because WeHer was all 670 million. Yeah, so we do think that will continue to support revenue and PATMI growth over the next 4 years in the construction segment. As for the negative for WeHer, we do see lower recurring share of profit from joint venture following the sale of PBSA Fund 1 last year. So, however, we do think that the worker dormitory and construction segment revenue will be able to offset this fall in share of profit from joint venture. Our outlook, as mentioned, it will be driven by construction order book. Secondly, will also be the worker dormitory, the increase in bed capacity, increased by 67% last year. So you'll continue to drive revenue growth this year. We do think that it will steadily ramp up this year. And last but not least, for WeHer, their Tuasville dormitory, which is the existing 15,000 bed worker accommodation, which has its lease expiring in November this year. We do think that it will be extended because currently the supply demand dynamics is still healthy. And because of the major construction projects upcoming, for example, Terminal 5, MBS Integrated Resorts, HDB BTO supply, we do think that the government won't be inclined to cut off this sudden 6,000 beds in worker accommodations. Otherwise, there will be a severe shortage in worker dormitory beds. Yeah, so for WeHer, we upgrade to buy with a higher target price of $1.08. We adjusted our SOTP model to include the Upper Thomson GLS site as well as the DoubleTree Hotel, which is upcoming this year. We don't think that it will be a very material contribution. Yeah. And also WeHer's PBSA Fund 3. Yeah, so that's for WeHer. I'll move on to Centurion. Yeah. Next slide, please. Yeah. Yeah, so for Centurion, I'll also be presenting on their second half results. Their revenue exceeded our expectations, and their adjusted PATMI fell below our expectations because there's an increase in administrative fees because of higher manpower costs. So so talking about how revenue exceeded our expectations, It's being driven by the Singapore PBWA, which is the purpose-built worker accommodations. Revenue increased by 24%. This is because there's a consolidation of the 6,200 bed Westlake Mandai, which Centurion previously owned 45% stake, but they bought the remaining 55% stake from Lianbing. So this contributed to the revenue growth. And there's also the about 1,700 bed Westlake Ubi in the east, which is able to generate additional rental of about in, additional 10% rental rates compared to the rest of the worker accommodations. So this also drove the Singapore PBWA revenue growth. After Career spin-off, which is a Centurion Accommodation REIT, uh, Centurion itself, the parent group, has a healthier balance sheet. Uh, as you can see at the net second last row in the table itself, the net debt declined by 38%. So their net gearing ratio also decreased by almost 20%. This is because Centurion received a net proceeds of I think about 400 million following the Careers spin-off. Yeah, so as mentioned, the negative is the increase in administrating fees. We do think that it's because there's higher OT pay because of Careers spin-off and also some legal fees involved. Our outlook for Centurion is that we do think that their FY26 PATMI will decline slightly by about 14% because there will be an increase in profit attributable to non-controlling interest where that is where Career will be parked under lah. So that's why more profits will go to Career. But after the distribution of dividend in specie, we do think that Centurion will own about 38% stake in Career going forward. And Centurion has collected significant fee income from Career. So in the fourth quarter itself, because Centurion still manage Career, they recognize about 6.5 revenue as well as 3.2, I mean $6.5 million in revenue as well as $3.2 million in PATMI from the management of Career itself. And because we estimate Career's revenue will increase by about 25% year on year in FY26, we do think that this will also drive Centurion's management fees recognized as PATMI in FY26. We do think that uh, the PATMI recognized from property management fees will increase by about 25% year on year to about 16 million. So this 16 million will be quite material as it makes up about 20 to 25% of the current adjusted PATMI. Yeah, so for Centurion, we maintain buy. Our target price is unchanged at 1.81. Yeah, and we value Centurion's quick built dormitories at a slight discount of 8 times forward PE as compared to other assets at 11 times. This is because two of the four quick built dormitories have leases expiring this year. So there's a bit of risk involved in terms of the renewing of leases. But we do think that going forward, the main story for Centurion is the healthier balance sheet whereby the management will be able to deploy uh early, and also because of their track record in deploying early, for example, in their student accommodations, it's more of a long-term growth story. And also because of the property management fees of Career itself, this will also support their PATMI. Yeah, so that's all from my end. I'll hand over to my other colleagues. Thanks.
Thanks, Iqbal. Yeah, I'll go through China Aviation Oil results. Next slide. So China Aviation Oil results exceeded expectations. It formed about close to 80% of our full year forecast. So there are a few positives that we observed from their results recently. Firstly, it's that their volume of jet fuel sold has increased significantly compared to the previous year. Total supply and trading volumes were up about 5% year on year, whereas jet fuel volumes in particular, they increased about 15% year on year to 8.8 million metric tons in second half of 2025. So this was mainly driven by China's passenger growth. It has grown about 21% year on year to about 79.7 million. And the increase in passenger growth has led to an increase in demand for jet fuel, and that really benefited China Aviation Oil business. Um, China Aviation Oil also has an associate called Shanghai Pudong International Airport, and this is a very key contributor to their earnings. Year on year, the contribution increased about 44% to 31.9 million in earnings. And we continue to expect further support from Shanghai Pudong International Airport, mainly because it's the largest airport in terms of passenger throughput, and it has been actively expanding. So apart from that, another benefit that we saw was margins expansion for China Aviation Oil. Gross profit margins increased 140%, even though revenue was down about 1.3%. And the dip in revenue is largely because crude oil prices fell in 2025. And China Aviation Oil tried to make up for it by really focusing on volumes. So their volumes really increased, as we saw earlier, and that allowed them to have a increase in PATMI by about 70%. So this large increase in volume meant that they were able to negotiate with their suppliers better because they are procuring a larger volume of oil, and so better spread negotiation plus them being able to spread the fixed costs across a larger volume base meant that their margin relative to their revenue increase was much larger. So apart from this, in China, there has been an increase in international outbound travel, and usually for China, the focus is on sustainable aviation fuel. So those flights that are departing China into international routes, they have to have a percentage blend of sustainable aviation fuel that is used. So with the increase in international air travel, there was an increase in demand for sustainable aviation fuel. And SAF tends to have higher margin, about 3 to 5 times higher than conventional jet fuel. And that also supported their margin expansion. So apart from that, currently China Aviation Oil is in a very strong balance sheet position. Their cash grew about close to 190 million. And this was largely because of their strong operating performance. Their operating cash flow increased about 24% year on year. And they also have cash that has been put in certain fixed deposits, and that further gave them interest income of about 15 million. The China Aviation Oil does not have any debt on its balance sheet currently, which we believe puts them in a strong position for either increased dividends or M&A. But we are um, likely inclining towards a possibility for M&A in the coming year. So outlook wise, the Civil Aviation Authority of China, it's projecting passenger in air travel passenger increase by about 5% for 2026. So despite air travel in China rapidly expanding after COVID, we still are forecasting for increased growth going forward. And their Shanghai Pudong International Airport associate, it's adding it's seen that airlines are adding more international routes from Shanghai Pudong. And one example would be China Eastern Airlines. So it's also adding new routes internationally, and that cements Shanghai Pudong Airport's status as an international flight terminal. Because of this increase in demand, what SPIA has done is to expand their current terminal. They are expanding into and are building this new terminal called Terminal 3, and that will expand their capacity by over 60% to 130 million passengers. And with increased capacity for passengers, we would expect more airlines flying from Shanghai Pudong, which would increase demand for jet fuel, and that would be a very strong push for China Aviation Oil business. Apart from that, China Aviation Oil is also building end-to-end supply chains. So end-to-end means the procurement, the procurement, the sale, the distribution of sustainable aviation fuel. They already have this end-to-end supply chain in Hong Kong, but now they are also expanding it to China and Europe, where although they already have SAF operations there, they're trying to expand it further to build that end-to-end operation. So we know that SAF commands a premium of about 3 to 5 times compared to jet fuel. And so with the expansion of the SAF supply chain in Europe and China, they'll be able to further expand their SAF business, which can further support their margins in the future. Because the company is in a net cash position, we are also expecting capital to be deployed into M&A in 2026. So there has been a focus on China Aviation Oil to expand into capital deployment for the past few years, but they haven't done so. But we think the pressure has increased, and they will likely deploy their cash into either sustainable aviation fuel related businesses or like other like storage assets or pipeline facilities, which can further strengthen their core business. Their preferred region for investment is said to be Southeast Asia, Europe, and the Americas. So apart from that, we think the the Middle East conflict, it does have a mixed impact on China Aviation Oil. So China Aviation Oil's business is mainly focused on buying jet fuel for cheap and then selling it locally to the airports in China. So that's their main business. And apart from that, they also do trading of fuel. With the crude oil price increasing to over $100 per barrel, we do expect that their margins might slightly be impacted because they are likely procuring jet fuel for higher prices since the prices have already increased. And unless they're able to pass down the cost to their consumers, there will be that shrink in margins for them. But what the company is doing to deal with this is to procure from a more diversified geography. So previously, they were only focusing on a few geographies, but now they're diversifying their source of supply. So they're trying to exploit the price differential to acquire at different cheaper prices and then selling it for higher within China. And we also see that the impact on crude oil and the impact on jet fuel will still be under pressure because although there are countries like Japan and the G7 which has been increasing output of crude oil from their reserves and they're selling it to the market. Japan is selling it below our pre-COVID prices to reduce the impact of the price shock. But no, there has been continued attacks on key facilities in the Middle East. So the UAE oil terminal has been attacked. The US also attacked the KARG facility in Iran, and KARG facility is very important for China because majority of the fuel that has been refined is exported to China. And although the US did not attack oil facilities, we still think it's a stress factor for oil prices. So going forward, we think China Aviation Oil will continue to be able to procure at lower prices, but the stress on oil prices will still be there, and there might be an opportunity for China Aviation Oil to make money through trading of oil. So given how volatile oil prices are, there is a chance for them to exploit this and make money through short-term profits. But what we understand is that they are not very keen on doing that. Their focus is more on using trading and hedging as a means of risk mitigation rather than making short-term speculative trades, especially those that require a lot of cash that burns their cash facility. So overall, we are still very positive on China Aviation Oil. We have a buy rating on them at $2.53. They're currently trading at a PE multiple of 11 times 6x. So with that, I'll pass on to the next speaker.
Thanks, Hashim. I'll move on to the technicals. So first I'm looking at the S&P 500. In terms of the chart last week, it was down for the third consecutive week. Last week was down 1.6%. In terms of the daily chart, I think after the breakdown of the 6,800 support level last week, retest on Tuesday and Wednesday, it met resistance and price close near the week lows, near the Monday swing lows. So I think currently for now is it probably could retest the 6,585 horizontal support level, which was the swing lows in October to November, as well as we have it's quite near the purple moving average, which is a 200 SMA you see in the chart. So overall for now, I think resistance likely to be at 6,680 to 6,947, while support is likely to hold at 6,520 to 6,608. So that's all from me now. I'll hand over time to Glenn for the Singapore banking monthly.
Okay, thanks, Zay. Yeah, so I think, before I move on, just to let everyone know that Paul is on leave. So I see some questions in the Q&A tab that is meant for Paul. Yeah, he won't be able to answer them, but we can just put it in the P3 app, the community app, and he'll be sure to answer them on that platform instead. Yeah, just to let everyone know that Paul's not around. Okay, so let's move on to the Singapore Banking Monthly. Yeah, next slide, please. Yeah, so we'll just do a quick recap of the fourth quarter earnings results for the three Singapore banks. I mean, the main focus for the bank's earnings was that it came in slightly below expectations. Overall, earnings did by 5% year on year, mainly from the lower net interest income. It fell by 5% as well. And also the net interest margin compression, which it fell by 22 basis points year on year. But on the positive side, fee income growth of 13% did help to partially offset this lower net interest income. In terms of their guidance, they are guiding for the margins compressions to ease slightly in FY26. We have sort of seen that already, in the fourth quarter of 2025 for the banks. If you look on a month-on-month basis, some of the banks actually showed a slight increase, 1 or 2 basis points kind of increase in the net interest margins on a month-to-month comparison. So moving forward, we believe that there could be a possibility that margins will may even improve, or at least it won't decline as fast in 2026, mainly from the deposit rate cuts that have begun to flow through and will flow through even more, and also the stabilization in interest rates. Overall, for 2026, we expect the PATMI to increase by 7% year on year, as the fee income growth will be partially offset by the decline in net interest income. In terms of their capital return plans, all three banks have committed to complete their previously announced capital return plans. But what's new, I guess, or not new in this sense, is that the banks haven't really given any updates, on whether or not they'll be continuing with more capital returns. Yeah, so I guess it's more of a wait and see, and hopefully we'll know hopefully by third quarter of this year, whether or not there will be even more capital returns, because all three banks do actually have quite high CET1 ratios. So it shows that they still have some ways to go, right, before they can actually complete reach their optimal CET1. Optimal CET1 for the banks are around 14%. Most of them are hovering around high 14 to close to 15% kind of CET1 ratio. So you're looking at 1% excess capital, and that equates to a few $1 billion. Right, so for these banks, they need to give it back. Otherwise, there are only two ways that banks can lower their excess capital. The first one is to do an acquisition, and then the second one is to give back in terms of dividends or share buybacks. Right, so I believe that there will be some opportunity for more capital returns in 2027 or even in 2028. Yeah, so now moving on to the interest rates. Next slide, please. Thanks. Yeah, no, interest rates, we are seeing some slowdown in the decline. So it fell by 2 basis points month-on-month for the 3-month SORA to 1.14%. And this is the smallest month-on-month decline that we have seen in 20 months. So there's some positivity there. Year-on-year, it still fell by 168 basis points, which is also the smallest year-on-year decline that we have seen in 8 months. So this is also back to my previous point, where we are seeing some stabilization in the Singapore interest rates. We also believe that the decline will taper off for the rest of the year, mainly as the expectations of rate cuts are lowered, due to the higher inflation coming from the war and the Middle East conflict. In terms of the HIBOR, it declined by the fourth consecutive month in February. It was down by 18 basis points month-on-month, and also by 121 basis points year-on-year to 2.69%. Now, moving on to the next slide, we'll be looking at the loans growth. So in terms of loans growth, it's still very healthy. It was up by 6.1% year-on-year in January to 888 billion. This is exactly the same as the previous month's growth in December of also 6.1%. In terms of guidance and of what the outlook for 2026, we are expecting mid to high single-digit loans growth, really driven by the further recovery from the very low interest rates that we are seeing in Singapore. But then again, like to what I said earlier, the Middle East conflict and the Iran war, it's a bit of a double-edged sword. While it will improve margins, right, but it might hamper some of the growth in loans growth because of higher inflation, and also the rates are not going down as quickly as expected. The banks are still guiding for mid-single digit in loans growth in 2026. For business loans, it was up by 5%, mainly supported by the manufacturing segment growth of 38%, while consumer loans were up by 8%, and this was supported by the housing loans, which grew by 6% in January. Now, moving on to the next slide, we'll be looking at the deposits and balances and also the current account and savings accounts ratio. So deposits and balances has continued to grow. It was up by 5% year-on-year, right? On the right chart here, you'll see the orange line. So the orange line, you might see that, why is there this big sudden dip in the year-on-year growth, right? The orange line, but that's actually growth. So we are still seeing continued growth, but it might have decelerated a bit, the growth, right? But we are still seeing strong, healthy growth of above around mid-single digit. So for the CASA ratio, which is on the chart here on the left, the proportion rose to 19.8%, and this is the highest that we have seen in 3 years. And it grew also by 12% year-on-year. So we believe that this is very important. And why is this so important? It's because the current account, savings accounts, or CASA in short, is very important for the banks. This represents the lowest cost of funds for the banks, right? So you mentioned your multiplier account from DBS, or your 360 account, OCBC, the UOB1 account, right? These are all the what they call the current accounts for the banks, and these are the lowest cost of funds. I think DBS did say that on an average, right, they're only paying a few I think 5 basis points of funding costs for current accounts. So the higher this ratio and the higher this amount, it means that they can lower their funding costs. And on top of that, you see banks like UOB and OCBC are continuously cutting their flagship accounts, right? If you meet all the criteria, of course, they're continuously cutting it. So this will only help to even lower their funding costs even more, right? And this will flow straight through to their margins and net interest income and also their profits. So the higher the proportion, then the better it is for the banks. And we're actually seeing it increase. Yeah, and we expect it to continue to rise, mainly from the higher interest fixed deposits that have matured. You put in about a year ago, and now they're maturing, and also all your T-bills are maturing. So they are now shifted it back straight to your current account, and a lot of customers and shareholders, customers for the banks are just placing it back there while they have sort of a bit of a wait and see approach. So this is actually beneficial for the banks because essentially it's very low funding costs deposits for them. Now, moving on to the next slide, we'll be looking at the SGX statistics. So in terms of their volumes, the SDAV surged by 45% year-on-year, and also the DDAV also grew by 22% year-on-year. This is mainly attributed by the higher volatility. So we use the VIX, which is the market index that measures the implied volatility of the S&P 500 index. It was up to 19.1 in February, and this is higher than January's level of 16. So we believe that heightened volatility could continue to persist for the rest of 2026, mainly with the Middle East conflict going on, and this will benefit both volumes, and this will also help to boost SGX's earnings because they are heavily dependent on volume growth. And also on top of that, the additional 1.5 billion injection into the EQDP, which now totals 6.5 billion, will also help to further boost volumes. In terms of the top 4 equity index futures turnover, it declined by 7% year-on-year, mainly due to the decline in the FTSE China A50 index futures volumes. Now, moving on to the next slide, we're looking at the bank's performance for February. So the share price performance for the 3 local banks pulled back slightly in February. It was down by 2%, mainly as they retreat from the January highs amid the broader market volatility and also a mixed fourth quarter earnings season. So the decline was primarily driven by both UOB, which was down 3.4%, and also DBS, down 3.5%, as both of them did miss their earnings estimates. In contrast, we're looking at OCBC, it was actually up by 0.9%, because they did have a better quarter of earnings, right? They had a 3% increase in their fourth quarter PATMI and also quite steady loans growth, and they did give a higher final dividend. Yeah, but I mean, of course, DBS also gave a higher dividend, but that was really, we believe that was really priced in because they announced it almost a year ago, and a lot of people were expecting that, right? But for OCBC, it's still stuck to that 50% payout ratio. And because of their higher earnings, right, they give back more in terms of dividends. So we do expect both OCBC and DBS's performance to remain quite stable in FY26, as the fee income will help to offset some of the NIM compression and net interest income decline. And for UOB's earnings, it should recover better than the other two banks, mainly because of the absence of the preemptive provisions that they had in the third quarter of 2025, of 615 million. Yeah, so moving on to my last slide and to conclude the banking monthly. Yeah, we maintain neutral for the banks, because we believe that the low interest rates and so it will still continue to decline, but at a slower pace. We will continue to compress the margins and net interest income, but the increased volatility as well as the jump in the SDAV will help to boost the capital markets and fee income, most importantly, helping to offset some of these headwinds from margin compression and net interest income decline. And also the spiking oil prices and the Middle East conflict has raised inflation risk. So this could potentially delay further rate cuts and help to support the bank's margins. In terms of asset quality concerns, the main concern would be UOB, right? But we view that their preemptive provisioning that they did in the third quarter as very prudent, and also that the overall risks are quite contained, in terms of both the US and the Greater China NPLs in their CRE sector. The bank dividend yields are still quite attractive, at around 5.1%, and the ongoing share buybacks that they are having will help to improve the ROE. In terms of preference for the banks, we prefer DBS, which has a fixed dividend policy all the way until 2027, and also OCBC for their wealth management growth, and also the excess capital they have, which is the highest amongst the three banks, and that there's a higher possibility of more returns going into 2026 and 2027. Yeah. So that's for the banking monthly. Yeah. Now I will be doing the Singapore weekly as well because Paul's not around, so I'm doing the weekly this week. Yeah. So for week 12, for the macro last week, we saw that unemployment in Singapore is very stable, right? It's still at 2%, so not much change there. The labor market remains exceptionally tight, which helps to support the domestic consumption and also upgrading demand in the residential property sector. In terms of the US, we got some CPI numbers for headline CPI, and the core CPI is both very flat and not much change already from January, right? 2.4% and 2.5% respectively. And both also have met the consensus estimates and forecasts. But then again, to note that these figures are actually pre-Middle East conflict or pre-war kind of figures. So it's very backdated, right? The figures that we will be looking out for, and I think have better better outline into what it would look like would be the March figures, because that will price in a lot of the inflation and also the war, the current conflict, right, numbers. Core PCE was also up by 3.1%. It met inflation, it met expectations, but it's still above that 2% target that they have. And I think moving forward in February, March, for the rest of the year, at least the first half, I don't think that we will see it decline much further because of the higher oil prices. Retail sales was down 0.2% in January. There's a slight contraction mainly due to the very bad winter that they had in the US. But a lot of the markets are really looking past this to see how the consumer will handle the inflation shock in March that will be coming. So February figures will also not really reflect the inflation shock. So I think March figures, then those are the figures that we're looking out for in March. Yeah. Now moving on to the next slide, we'll be looking at the tactical views for this week. So we believe that the prolonged closure of the Straits of Hormuz is setting the stage for a global inflation shock. And while I said earlier the February figures for the inflation, has sort of met expectations on a year-to-year basis, but this data is really quite dated, right? Because it doesn't reflect the recent surge in the oil and freight costs. So the markets are now bracing for a much sharper rise in March. And the current estimates are anticipating headline inflation to jump to 2.87% and also core inflation up to 2.6%. And with the reopening, and the ending of the war, although Trump says, it's a very fast, it's going to be quick, right? But it's still very uncertain, the timeline. It has pivoted to a higher for longer interest rate environment and sort of effectively pricing out near-term Fed rate cuts. But Asian equities, has pulled back this week, as a lot of the investors digested sustained tight monetary conditions. In terms of our view, we are expecting the higher for longer rate outlook to cement the margin resilience for the local banks like the DBS, UOB, and OCBC into 2026, and also help to provide a solid buffer against broader market corrections. So I think this answers one of the questions in the Q&A that I saw earlier, whether or not the higher rate environment is better for banks and bad for REITs. Yeah, so we also believe that it's the sustained high rate environment will also be a near-term headwind for the Singapore REITs due to the elevated borrowing costs and compressed yield spreads. But we are continuing to see capital rotate into the ASEAN safe havens, and a lot of them are exiting the oil-dependent Northeast Asian economies. And on top of that, it's supplemented by the EQDP liquidity injections, and Singapore equities also offer compelling valuation support and earnings visibility amidst this macro turbulence. So our position as a safe haven does come in quite handy during these volatile times. In terms of weeks ahead, we do have quite a few key figures, for key numbers that are coming this week. So we have the US retail sales numbers and the US FOMC interest rate decision also as well this week. And for those who are interested, the BOJ interest rate decision as well, I think on Wednesday. In terms of corporate insights webinars, 2 upcoming. Those should be coming, I think, the following week. So it will be LHN on 25th and Lam Chang Creations on 27th. Yeah, that's the following week. Yeah, so do feel free to sign up for those two at 12 p.m. on those days. Yeah, okay, so I think that's all. We'll just jump straight to Q&A. Yeah, maybe I'll just take on a few first before I hand it over to the rest of my colleagues. So yeah, someone asked, any take on NEO's results? Yeah, NEO's results are quite a good turnaround, the fourth quarter results. So for those who are not familiar, NEO did have the first quarter of profitability, right? You're looking at net profit of 40 million. And this is quite a big swing from the previous year loss of around 1+ billion loss in fourth quarter of 2024. Yeah, so it is really a big turnaround, and what drove this turnaround was operating leverage. They had a good product mix as well because they had the higher margins. ES8, which is the larger SUV, helped to boost their average selling prices. And also, I think the main difference maker was they had a lot of cost control and they cut a lot of costs, right? So they slashed their R&D expense by 44% and a lot more cost control. Yeah, so they have stopped growing at all costs, right? As a lot of these EV growing companies, right? They like to grow at all costs. They don't really bother about their bottom line, but I think they're trying to turn it around. Yeah, but their guidance is very aggressive, right? First quarter, they are looking at like almost the doubling of their deliveries, and also revenue growth of also same, right? Doubling. But the main difference, and I think the main thing that we need to watch out for would be the cost, whether or not they can continue growing at such a pace while still cutting costs, right? Because the main reason why they managed to actually have such a good positive bottom line this quarter was because they cut a lot of costs. So if now they want to do both at the same time, right? Like grow at double, like 2x, but still also lower their OpEx. So they're growing at both ends. So for a company to do that, it's really very tough whether or not they can do that. Furthermore, they are still trying to expand their the battery swapping network that they have. And that's very, very capital intensive. And also, if they want to keep up to date with all the new autonomous driving, or they will need more chips, more R&D into AI and spending more. So all this actually requires more money, more expenses. But now they're going to cut back. So whether or not the vehicles that they are pushing, right, will be able to maintain that high margin, that will be the biggest question. Yeah. So I think first quarter will be quite interesting to watch in the 2026, whether or not they can actually upkeep with the demand, and also the quality that they are known for. Yeah. So I answered that one, whether or not the war is positive for the bank and negative for the REITs. Yeah, basically, it is positive. We believe it's positive for the banks and negative for the REITs. Yeah. For the banks one, I can answer in depth, but maybe the REITs part we can get Darren later to answer. I think I saw a few more questions. Yeah, does DBS have any exposure to private credit fund? No, I don't think they have. Even if they do it's really, really a very, very small portion. But no, they don't have any big exposure or like notable exposure, that's what they would say, to private credit fund. Yeah, so there's this question here again. I think Ian asked it. I think very similar because I saw this question last week as well. For the three banks, which one have higher exposure to Middle East and potential negative impact of Middle East war becomes protracted into months? Yeah, so they don't have any direct exposure to the Middle East, right? If you count the wealth management side, then yes, I think DBS and OCBC or UOB, yeah, they do have like some wealth management clients there, but those are very high net worth. They don't say where the clients come from, right? They may be overseas clients that just reside in Middle East, right? So they may not be really the Middle East based kind of clients, in terms of their wealth management or the high net worth clients. So they don't have, in terms of loans, they don't go very much into the Middle East. So a lot of the impact or the negative impact will be secondary kind of impact, right? There'll be some flow through. Of course, you'll see inflation will increase, we will see fuel prices going up. This will hit the SMEs the hardest, right? Because the cost will increase, but they can't make it flow through straight away. So these will hit their customers indirectly more, right? And then we will see possibly loans growth slow down a bit, right? Now it's mid to high single digit, right? Maybe we will come in at low to mid single digit instead, right? So we will see like loans growth slow down. And there's also another question here I saw later, whether or not we get higher provisions for bad loans. Yeah, we might get higher provisions, but I think the banks are well set aside. If you look at just DBS's management overlay, they have more than, I think now it's 2.3 billion of management overlay. The other two banks don't say how much they have, but I'm guessing it's around the same kind of proportion, right? So 1 plus 2 billion management overlay, and then you see that the UOB has put on another 615 million in terms of preemptive provisions, right? This will more than cover enough of overlay of any potential increase in NPL or NPAs for the banks or bad debt. So I don't see now any higher provisions for bad loans, at least not in the near term. Maybe in the long term it'll be hard to say, but near term I think you'll still be keeping to whatever they have guided, which is around 20 to 25 kind of basis points for credit costs. Wait, let me read this question. Which one is more powerful in determining bank's earning? Higher volume share with lower NIM or lower volume share but higher NIM? Yeah, that's an excellent question. I would say the more powerful one would be lower volume share but higher NIM. If you look at historically what we have seen, right? You look at COVID times, when loans growth was like 1 or 2%, or even I think there was a dip in loans growth, but NIM went skyrocketing. Right, you see that the bank's earnings were really very healthy. And then now we turn around when rates went up, and when rate cuts. That was right post-COVID. But during COVID, we saw that rates went down all the way. But loans growth didn't really move as much. So there's a bit of a difference, right? When the sensitivity comes in. So it's quite complicated, but let me try to simplify this and make it quick. Otherwise, I'll take up like one whole hour. So when the rate cuts do come in, or on the flip side, when the rates do go up, right? The banks actually, when the rates do go up, let's say, the banks are able to reap that benefit, right, almost immediately in terms of their net interest margins, right? And you'll see loans growth sort of like slowly peter off, but it won't be an immediate like cut to loans growth. But on the other round, if you see loans get cut immediately, margins also get cut immediately, but loans will take time to go back up, right? And it will be like a catch-up kind of thing. It's a lag effect in terms of the volumes. So I would say higher NIM would be more beneficial for the banks because it's an instant effect for the banks. Like how when they cut their funding costs, it goes straight into their bottom line, right? It goes into net interest income and then it flows straight to earnings. So I wouldn't say more powerful, but more immediate effect would be lower volume share but higher NIM, right? The other one takes a bit more time, the volume share and lower NIM. Yeah, when you say volume, I assume it's loans growth lah. Yeah, right. Volume growth. Yeah. So I hope that answers your question. Yeah, quite a few private credit. Yeah, so that I don't know, the banks don't really have much exposure to private credit. Yeah, let me go and look at it a bit more and see whether I can find any more information on this. But yeah, it makes up such a small number, right? Like a percentage that it really does not move the needle much for the banks at all. Yeah. Yeah, in terms of financial industry, I'm not sure about a lot of those smaller ones. Because if they're not really listed, right? They don't their financial statements are not out there, so it's very hard for us to see. Yeah, but in terms of all those listed companies, like the banks, all the smaller ones, they don't really have much to private credit or private equity. Hey, okay, I think that's all for me. Let me see again. Okay, yeah. Okay, I'll hand over the time to the rest of my colleagues. Thanks.
Yeah, thanks, Grant. I can take on some questions. How is supply chain disruption of helium affecting Micron? Yeah, so some context. Because of the Middle East disruption, there's some concerns regarding helium supply, because Qatar in that region supplies about 30 to 35% of the global helium supply. And helium is a very critical component being used in the semiconductor wafer processing. Wafer processor. So it's being used in the cooling of the wafers. Even though it doesn't contribute much to the overall cost, maybe about 1 to 2% of the overall cost in wafer production, it is a critical component. So it is still necessary in the entire supply chain for wafer. And Micron, because it's an integrated device manufacturer, is also responsible for producing wafers. However, we do think that it is more favorably positioned as compared to Samsung and SK Hynix in this regard, because Qatar produces 30 to 35% of the global helium supply. So the remaining majority of the remaining supply, which is like 60+%, is being produced in the US itself. And because Micron has a stronger presence in the US as compared to SK Hynix and Samsung, I do think that they will be more favorably positioned because they can take on this supply from the US the helium supply from the US. Yeah. So hope that answers the question. What to expect from Micron results this week? Yeah, so I think a lot of attention will be on the high bandwidth HBM4 memory chips, which Micron samples are being shipped to customers, and I think volume production will start in this quarter itself. So I think I do still think that they will beat their guidance. Their previous guidance was very positive. It was a huge acceleration from about 40% revenue growth, and they guided about 100% year-on-year revenue growth because of the DRAM shortage. So they are able to increase the price. And I think currently the landscape is a bit more competitive because SK Hynix in their earnings they disclosed that they secured 70% of supply to Nvidia's Vera Rubin GPU. So I think Micron will be pressured to announce maybe like a major supply to a customer in terms of their HBM4. Yeah. But I think the overall demand supply landscape is still positive because hyperscalers have been guiding accelerating capex. We do think that that will benefit Micron, and because of the overall supply crunch, we do think that DRAM prices can still go up this year. Yeah. So I'm positive of Micron's results this week. Yeah. I think I got one last question about WeHer. Wait, any idea what are the possible reasons for negative sentiment for WeHer despite decent results? Yeah, so some of the possible reasons I can think of is maybe investors may be afraid of the risks involving the Tuasville dormitory because it is a 16,000 bed dormitory uh which has leases expiring in November this year. So investors may be worried as we get closer to the deadline how possible it is for the lease to be renewed. But I think management did mention that in the call that usually this kind of lease extension will be known about 3 months before the actual lease expiry date. So we may have to look forward to about August before we know the actual results. But management did mention that they are engaging with the stakeholders. I mean with the authorities. So that is a positive. We do see that as a positive because engagements means there's a possibility for renewal. Other possible reasons for negative sentiments, maybe investors may be worried about the recurring income portion after the sale of the PBSA Fund 1. But for this year itself, I do still see the construction and worker dormitory uptake in terms of order book as well as worker dormitory beds being able to offset this slight drop in share of profits from joint venture because of the PBSA Fund 1 sale. Yeah. So I think the drop in WeHer price, I feel like it's just profit taking. I think there's a lot of positive sentiments being baked in even before the results are released. Yeah. Yeah, I think I'll hand over to my colleagues for now. Yeah, thanks.
Hi everyone, let me take one question on Adobe. So the question asks, how was Adobe result? So the result is in line with our expectation. So what was announced is, as usual, there's increasing in AI traction is still going strong, but what the investors are looking at, I guess, that's the revenue, that the annualized recurring revenue for their Firefly products, their AI features is growing at 11%, but the outlook for next year, since this is the fourth quarter, is at 10%, so it's a declining growth. So people are wary the growth is not accelerating as what they expected. Because this is software companies, the competition is very high. So if they can't really show that the earnings coming from the AI traction is going higher, that they might losing their market share to the other AI startup, especially for Adobe, because you get Canva, you get many others like software. It's much easier to generate marketing material through prompt and so on. So we expect increasing competition for Adobe, such as like mentioned earlier, Canva and so on. But we do think that Adobe is going to remain resilient as well, of course, because they do as well incorporate the AI features into their business as well, which is proven through the strong AI traction. Yeah, also we are still positive on Adobe because they are serving mainly on enterprises, and when you serve enterprises, they want multi-channel, like that you go Photoshop, Illustrator instead of just just one marketing channel material. Like I think like Canva, which is a simpler version compared to what Adobe have. Like their their ecosystem of product is quite vast and has been enterprises have been using their product for so long that I think it's quite sticky now for them to just change product right away. Yeah, and also not to mention the biggest important point, though I think with the AI features going on around, what Adobe offer is that their stock keeping unit means that the enterprises would prefer to using Adobe because that would protect them from any infringement or lawsuit for using intellectual property coming from the other creative providers. Because if you're using AI, it's much better and much more security for you to just using AI generated photos that is coming from Adobe wide stock keeping units that they already have for the last few years already. So yeah, it's not so much an Adobe when it comes to crude. It's like you wouldn't expect hypercrude coming from Adobe. So and so on. We do think that there's less crude coming from Adobe, I guess, but they still would remain resilient. But you don't really expect hypercrude coming from Adobe. Yeah. So that's all from me for the recent Adobe result. We'll pass over to my colleague. Thank you.
Yeah, let me just take on one questions about FOMC, how many rates cut this year. So the upcoming FOMC meeting will take place on 17th to 18th of March, with the decisions to be announced in the early morning of 19th of March Singapore time. So for this meeting, the market broadly expect the Fed to keep policy rates on hold, given recent spike in oil price and amid geopolitical tensions in the Middle East. So, at previous meeting in January, Powell actually indicated that further rate hike are unlikely at this stage. So, as such, we also expect more guidance from Fed on how they will assess the recent inflation issue and timing of rate cut later in this year. And back to the figure, based on current market pricings, the probability of rate cut in near term is remain low, with the market now currently they're expecting like one rate cut later in this year with the probability of 24%. So from our view, we think that the Fed is likely to remain cautious for now as inflations continue to show some stickiness. So based on the latest data, CPI data for February come in at around 2.4%, which is still above Fed long run target 2% target. But like Glenn mentioned earlier, the data was released prior to the recent spike in oil price. So we think that inflations could remain elevated in near term. And given this backdrop, we expect the Fed to stay on hold for now and may consider easing later in year in inflations show clearer signs of moderating. That's all from me. I will hand over my times to other colleagues.
Yeah, let me take on some. Thanks, Sui. Yeah, hi Paul. Is there a downgrade on the property sector? Today CDF UL dropped quite sizably. Yeah, as you all know, I'm not Paul, so but I'll just answer the question. So CDF UL, we expect the share price to be very volatile, especially what's going on now, and the fact that they over the past year they've already made like 100% return. Yeah, so going forward, we do expect the property sector to remain resilient, especially since like the most recent launch, I'll just slip my mind, River Modern, even in the CCR region, that was 90% sold. So we are looking at the Pinery residences upcoming. We expect the demand to be very strong as well. So the demand mainly still from locals, Singaporeans and PRs. So property sector, yeah, we are still overweight on the property sector. So we think the fact that the share price dropped today is just a volatility, yeah, in the market. Yeah, that's our view. Hi Iqban, what's your view on UIB at current price? Yeah, as you all know, I'm not Iqban also, but I'll just answer the question. So for UIB REIT, the timing of the IPO is very, very unfortunate. So previously at 88 cents, you're looking at a yield of about forward yield 2027 about 7.8%. So at current share price, the forward yield has jumped to about 10% because of the fact that it's now traded about 82 cents. Yeah, so if you compare it to the current price of the most close competitor, which is close peer rather, say Pet REIT. So they are looking at a forward yield of probably around 7%, 7.5%. So purely based on that, the UIB REIT, the portfolio is still very attractive. And there's on top of that, there's another question also in at the bottom asking about is it true that UIB's real estate occupancies are below 90%? Yeah, that's true also. Currently it's at about 89% for the portfolio occupancy, but they have indicated that going forward, they have already signed some leases that are almost close to finalization. So within the next few months, the occupancy will likely increase about 93%, and by the end of this year, it's likely to be closer to 98%. 97, 98% for their portfolio occupancy. Yeah, so all this has been taken into account, and their yield based on that will likely be around based on current price about 10%. So yeah, so that is just some updates on the UIB. Yeah, but other than that, the timing of the IPO because of the war was very, very unfortunate. Yeah. Okay, let me scroll through the questions. Bow state decreased somewhat. Would you think it will be back to 220 level or even higher? Yeah, so we don't cover bow state, so yeah, I can't really comment on that. On the question. Yeah, but I'll just leave it there for TA for Zane to answer. Thanks, Zane. There's a question on any update on SI engineering as you replace class in the STI reserve list. Yeah, so actually for this, we won't have much impact, just that you'll be next in line to enter the STI should any of the 30 constituents drop out in market cap or anything. Yeah, so I think that not much impact. Yeah, but I'll just leave it there because it's SI engineering. Maybe Hashim has something to add. Yeah, but generally for class, it's not on the list itself, so we do not expect much fund outflow or anything of that matter. Yeah. Yeah, from those funds that passively follow the STI. Yeah, UI Bell State answered that question already. Yeah, will REITs be impacted by rate cuts if rate cuts are delayed, or have the interest rate costs have been largely hedged? Yeah, so yeah, definitely if rate cuts are delayed or if rates go up, so definitely that will impact the REITs, and higher for longer definitely will also impact the REITs as the interest cost will remain high. Yeah, but look on the interest cost hedge perspective, previously when rates were going up, a lot of the REITs hedged upwards of 80%. So we were looking at about 85% average interest rate hedge for most of the REITs. But over the past year, a lot of REITs started to let these hedges fall off, and they didn't so-called enter into new hedges because of the fact that the outlook of interest rates were coming down, right? So the interest rate hedge percentage has fallen to below 80% on average, or 70 plus. Some REITs are even having just about 50% of their interest or their debt on hedged. So definitely that will impact the REITs. But going forward, in light of all this, the war and such, it is possible, or personally, I think some REITs will start hedging slightly higher, especially those that are about the 50% mark for interest rate hedges. Yeah, because of the fact that it is uncertain, and if inflation spikes and whatnot, then there is possibility that interest rates go up. Or yeah, so because as you all know, REITs are not in the business where they try to hedge and try to make money off the swaps. It's literally just stability and try to hedge and stable outlook of the, or rather fixed interest costs, or rather interest cost visibility. Yeah, that's the term. Yeah, they want to have interest cost visibility, so they hedge. Yeah, it's not so much like hedging for to make gains and whatnot. Yeah. Um. Yeah, what affects Singapore REITs? Yeah, I answered that. Mm. The newly listed UIB REIT is in which sector of the REITs? Yeah, it's in industrial sector. What's your take going forward despite not so encouraging opening price? Yeah, so for UIB REIT, the portfolio is like in Singapore and Japan, so it's very stable properties. And the fact that one thing I like is that they have a 80% management fee in units as compared to the other two REITs that IPO'd last year where they have 100% in units. So um yeah, they do have room to make it lower over time, and so-called is it's not really so-called the yield is not really managed, because after all, if you're paying all your units in all your management fee in units, you can pay a higher dividend payout for that particular year. But if you pay 80% in units, that means that 20% is still paying cash. So basically that yield is lower in in that sense. Yeah, because you use a portion of that year's distributable income to pay out the cash for management fee. Yeah, so for that perspective, UIB is attractive, and the portfolio generally, yeah, we expect occupancy to start ticking up, and we also expect positive rent reversions in the mid-single digit generally. So yeah, despite the not so encouraging share price, I think the REIT is still interesting and something to look out for. Yeah, and like I mentioned earlier, if you compare it to the closest peer, like market cap wise and the properties like AMC REIT, it is trading quite attractive. Yeah, almost 10% yield now at the current price. Yeah, there's still quite a few more. I'll hand over to my colleagues first. I'll come back in a bit. Yeah, thanks.
I'll try to answer some questions. So, how does the war affect SIA and SETS? I think for SIA, one of the major impact is that their fuel costs will increase. So SIA has hedges on crude price as well as jet fuel price, but it's not 100% hedged. So what we understand is that about half of their fuel costs are hedged. So inevitably their oil prices will increase and their fuel costs will also increase along with that. But benefits wise, we think SIA can benefit from certain route demand. So previously, routes that went from India to Europe had a stopover in Dubai or Qatar. Now it's likely going to be going through Hong Kong and Singapore. And SIA is trying to capture that demand by having increased flights from to Europe. And yeah, for SETS, we don't see major impact on their operations, largely because they are a global logistics player. Previously, they were only focused in Singapore. Now, after the WFS acquisition, they have operations across the globe. And Europe, Middle East, and Africa makes up about 20% of the total revenue for them. And even though the war might have affected air cargo space, we think SETS will be able to manage that because they adjust their routes according to where demand is. So even though Middle East might be closed, for instance, air cargo has to go through some other routes, and because SETS is a global player, they're able to cater to that increase in demand in other routes, while the Middle East route might have a lower demand. with the disruption, we still think there will be demand for certain type of goods, certain time sensitive goods like pharmaceuticals that will still go through sets, and the impact on sets might not be very significant. But it also depends on how long the conflict is going to last in the end. Okay, I think the update on SIA Engineering replacing STI. So yeah, we still are bullish on SIA Engineering. We don't expect it to, I mean, our thesis to change because it's included in the reserve list. It's still a very strong player that's riding on the back of MRO demand. It's a strong OEM relationship with engine manufacturers, differentiates it from other MRO players, and we continue to think that the backlog of aircraft deliveries will continue to be there. It's over 13,000 combining Boeing and Airbus. So we don't think it's going to be fulfilled anytime soon. And so demand for MRO will increase, and SIA Engineering will also be a beneficiary. So yeah, another question on sets. So yeah, I touched on it already. So we don't expect much impact on the operations. Certain goods will still continue to have demand, and because sets is global in nature, they would be better able to cater to increased demand in certain routes, while there might be a decrease in demand in other routes. So which are the oil producing companies that could benefit from high crude price? So we cover China Aviation Oil. So earlier I talked about how the procurement cost might increase for China Aviation Oil because overall crude prices are higher. So when they are acquiring from suppliers, the acquisition price will technically also be higher. But China Aviation Oil not only just buys low and sell high, they also do trading of crude oil. And so the volatility in the crude price means they can benefit from this price differential. So China Aviation Oil might potentially benefit, depending on how persistent the Middle East conflict and the share price is. So Lendlease new unit price at 558 cents for existing shareholder is higher than current price. What's your view? I think it's priced pretty tight. When Lendlease REIT opened for trading today, it was at 5.6. So right now the price has dropped to 555, but we don't know what price it's going to close at. Ultimately, we think it's more nuanced than just the current price. If existing shareholders do not subscribe to the new unit, then it would be dilutive if the share price is higher than the unit price. So we have to wait and see at what price the share price closes, and whether it's above the net asset value unit of the price, which is what we should be looking at. So will crude oil prices likely stay elevated above $100? And if this persists into months, will we see demand destruction? So no one has a crystal ball, right? We do not know if will be elevated for months on end, but at the current rate, there is a continued attacks on oil terminals, and that means there will be demand side shock or supply side shock. Countries are trying to release the reserve of oil from their stockpile, and that is trying to soften the blow onto the oil prices. But as long as the Middle East conflict persists, then there will be continued pressure on oil prices. With the midterm US election coming up, our house view has always been that Trump wouldn't like high oil prices. It's because it means higher cost of living for their voters, and that means that doesn't sit well when it's a voting season for Trump. So there might be certain rollback of conflict, but no one knows, and we have to wait and see whether there will be demand destruction. Yes, there will be cost-linked inflation, and that can make it more expensive for for certain goods, and it ultimately depends on the elasticity of your product. A certain necessity-based goods, there will be continued demand. Others, we might see a trimming of demand for their goods if it's like a luxury based. I think there was a question on gold outlook on the chat. We continue to view gold positively, gold price positively, because in a uncertain environment like it is now, gold tends to benefit. But with the likelihood of rate cuts, being on hold, people are or capital is flowing into USD, and that means USD has been appreciating as we saw, and that affected gold price momentarily. But overall, we think the fundamentals of gold is still there. China's central bank is continuing to buy gold, and that is a large demand driver. And with an uncertain environment, gold is likely to be the safe haven asset. So our outlook on gold does not change, and so we are still bullish on prices. Currently, it's about 5K per ounce, and we expect it to further increase. I think yep, that's all. And I'll pass it on to the next speaker.
Yeah, sorry, just to hop in on the question on Sandisk, any view, any tail or headwind? Yeah, so we don't cover Sandisk. I can try to give a bit of context. So they're in the NAND space and also solid state drive. So basically what that does is they are mainly not within the actual high bandwidth memory space. So high bandwidth people call it like the hot data space, whereby the data is actually being processed to process for AI workloads. And then beyond this hot data, there's a warm data as well. So that one will actually help to offload the data memory to from the high bandwidth memory chips, so that it's able to keep some data to be used as standby data for to be fed to the high bandwidth memory chips. And because of this supply crunch in high bandwidth memory chips, there's also a strong demand for this NAND and SSD space because hyperscalers have also been ordering this, and I think SanDisk is sold out for this year in terms of their NAND products. And I think price of these products will also go up, and this will act as a tailwind because the big memory players like Micron, Samsung, SK Hynix, they are allocating resources to focus more on high bandwidth memory. So less resources will be focused on the NAND and SSD side. And that's why there will be a supply crunch leading to a potential price increase. I think that's why investors feel it favorably for SanDisk. Yeah. I think I can touch a bit on the adverse effect on Mac 7 stocks due to Iran war. Uh, Previously, a tailwind for Mac 7 stocks is that because we expect interest rates to fall, that's why you support the Mac 7 stocks valuations. But potentially, if the Iran war drags on and which leads to inflation, which may cause interest rate to stay at current levels for a longer time and not lead to any rate cuts, then this may affect people's sentiments on Mac 7 stocks in the short run. But however, in the long run, we do think that uh, uh, Mac 7's fundamentals are still there. Of course, except Tesla. We do think that there's a big tailwind in terms of the AI space. And I think valuations wise, it is still attractive. For example, Nvidia is only trading at a forward price to earnings ratio of 24. And people are saying like, why is Nvidia trading at a cheaper valuation than companies like Walmart? Yeah, so I think in the longer term view, the valuations for Mac 7 stocks is still healthy, even if there's an adverse impact in the short run. Uh, in the medium to long run, we are still positive. Yeah. Hopefully that gives some clarity. Thanks.
Yeah, maybe add on to what Iban has said, right? The other thing that we also need to look out for is, with the rise in oil prices, um, the hyperscalers, you look at Microsoft, Alphabet, Amazon, Meta, right? They will suddenly see a spike in their energy costs, and with AI being all the talk, right? It actually requires a lot of energy to run all these AI sort of data centers, right? So it takes a lot of energy. So uh, we believe that it could hit their operating margins a bit, on their cloud and AI infrastructure build out. Yeah, so maybe the analysts who cover them, Helena and uh, I think Fami, right? They can chip in a bit on this. Like, what is the impact now? Yeah, and how much will it impact them? Yeah, okay, I hand it over to them. Thanks.
Yeah, okay. While waiting for Helena and Fami to answer, let me just take on the remaining of my questions. The ongoing war, many thought on Singapore risks and potential headwinds if inflation stays high and no Fed rate cuts. Yeah, so I mentioned that earlier already. Basically, yes, the REITs will be impacted by the interest rates remaining higher for longer, or possibly even increasing. Yeah, so which REITs will be most vulnerable? So okay, let me run through the sectors. So just rough how the war will affect. So the issue now is of course the increasing oil prices. So higher oil prices will probably lead to high inflation. So um and for those logistics companies where they rely a lot on transportation and of course they need petrol. Yeah, so because of that uh the input costs, basically higher freight costs and whatnot will basically impact the logistics tenants, so they might be performing poorer. So um, I mean, I'm not saying that the tenants will default or anything like that, but it will just impact the costs. So basically they'll get higher costs, and possibly tenant demand as a result will also be weaker, especially from the fact that they cannot earn that much. And the ability to raise rents also, because if they're earning less, the ability to raise rents will be lower as well. Yeah, so logistics, I would think it will be the most impacted sector. Retail REITs is more of a secondary. The other REITs are retail, office, and so-called okay, so retail and office is more secondary, like possibly higher fuel costs will high inflation, and as a result, tenants will be impacted by lower discretionary spending by consumers as inflation hits the consumers and their propensity to spend becomes lower. So that could possibly impact the retail REITs as well. Office REITs not so much impact, but it's more on the interest rates, like higher, like I mentioned many times, really higher inflation. The central banks will stay hawkish, and then as a result, higher borrowing costs. So from that perspective, office will be impacted. For hospitality, of course, with the war going on, less people will travel, so that is also a sector that will be hit quite hard, in my view. Yeah, especially with so much uncertainty or what's going on. So a lot of people, travelers will likely think twice about traveling. Yeah, so that might also impact the hospitality REITs. Yeah, so that's just a quick overview of what might happen and how the war will impact the REITs. my general view on entity D3 in terms of currency risk and delayed rate cuts in view of the war. Yeah, so entity DC REIT, they are impacted by USD and the euro. So about 70% of their portfolio is in USD. That comes from the US, so it comes from USD, so they're impacted by the weaker USD. And for interest costs, entity DC currently they are 70% hedged. Yeah, so if interest rates go up, they will be impacted by that 30% that are on floating. Yeah. Yeah, so that's just a general view. Perhaps UIB REIT is a value trap as priced also tank at IPO. Yeah, so I don't think it's a value trap because after all, if the occupancy now is 89%, if management can execute what they mentioned at IPO that they can raise the occupancy to about 98, 97% by year end, and by mid year probably around 94, 93%. So occupancy will rise and with continued higher rents. Yeah, so I don't think it's a value trap for UIB REIT. Yeah, that's all from me. Hand over to my colleagues, probably Fahmi or Halina. Yeah, thanks.
Thank you, Darren. So I would continue from where Glenn left off. So on the outlook on the Magnificent Seven. So for the Microsoft specifically, I do think there's probably slight slow in the Microsoft growth now because there's news. First of all, is because of the oil. Second is because of today's news on the attack on the Microsoft data centers in the Middle East region coming from Iran and so on. So with these two factors, it would probably affect Microsoft growth as Microsoft thesis is mainly revolving around the its cloud Azure hyper growth. Like people are looking at that, investors are looking at that. So if there's a slight slowing in that aspect in the cloud revenue growth, then that would probably negatively affect Microsoft as well. And then direct effect for Microsoft would mean since Microsoft has a lot of data centers and running on the cloud services, it would mean higher oil, it would mean higher electricity to run the higher data set, which would translate to higher data center costs for them. So if this for prolonged, that's going to be a negative effect for them as well. So and also if the indirect effect for them would mean that higher costs for them to buy the semiconductors, for example, chips and so on, cost for them to run the operating expenses for them to run the data center as well cost. So, but then again, at the time moment, we don't think it would negatively affect Microsoft that really bad. But just have to look forward whether this war would prolong or not, and then might as well would have to update the outlook going forward. So that is for me, Microsoft. Pass over to the next presenter.
Hi, I just add on a little bit on what Fahmi said. So for hyperscalers right now, electricity is definitely a major operating cost for their data centers. It takes around 30 to maybe 50% of their data centers operating costs. So that is probably the biggest expense that they have after the hardware depreciation. So definitely a short energy spike is going to affect them, but it wouldn't be on a very big scale because for hyperscalers like Amazon and Microsoft, electricity is so important to them. So they usually lock in the electricity prices for periods like 10 to 20 years. And they're also trying to source powers from renewable sources like solar or wind sources. So we think short-term energy spike, it doesn't really affect their operating costs as much. So that's what I wanted to add on. Other colleagues?
Yeah, let me just answer one more before handing it over to Zane. Do your team or Phillip intend to cover UIB REIT, Centurion, accommodation REIT, assembly based in Hollywood? Yeah, so right now, usually for IPOs, we don't really cover initially. Yeah, but we'll probably wait a while. Yeah, and to see the performance and whether they can deliver. Yeah, but generally we in the near term, yeah, if there's a good story, then yeah, definitely we'll consider it. Yeah, but generally we don't cover immediately at IPO. Yeah. Yeah, thanks. Probably hand it over to Zane. Yeah.
Yeah, thanks. Darren, I'll move on to the TA. So let me just share my screen now. Okay, so first question is on based on TA, what's a good price to buy Capital Escort Trust, DBS, SIA? Yeah, first up for Capital Escort Trust. Okay, I think first support level I think reached last Monday over here was like around 89 cents level. So that's like one level to look at. Another next level to look at, if it goes a bit lower, I think would be somewhere around 86 cents level over here. 86 cents to 86.5 cents. So that would be, I think, some good levels to buy Capital Escort Trust. Yeah, last week at 88.5 cents also hit the 200 SMA level as well. Next one on for DBS, I think let's look at the chart. Yeah, for DBS, I think generally it should be a good place to buy. I think be some if it dips to this region whereby it's around 52.50 to 54 area. So previously this area right was there was quite a bit of consolidation during September to December period. So previous reasons I there was some support like last Monday where we tested this previous area of resistance and we saw a bit of a bounce. I think if there's another dip, I think to retest the Monday lows, I think that will be a good place to buy. Or if it continues to form a lower low, I think somewhere closer to the 200 SMA level, which is around 51.80 now, that would be a place to buy as well. Then for SIA, I think currently we are probably seeing some sort of a range bound kind of movement after the drop. So I think a place to buy, I think somewhere would be around somewhere closer to about 630 to 640 area because this was a level of support previously, June to January this year, and then there's also like a trend line support as well. Overall, longer term support line. So I think this will be quite a strong area of support at around 635. Okay, next one is for Apple Corp. Yeah, for Apple, I think generally it's still pretty strong. Price just kind of pull back into this general uptrend channel over here. So in terms of the current price action, I think probably we're seeing a bit of a sideways kind of with some resistance at 5 and 10 SMEs level for now. Last week during the rebound. So currently some resistance I would think is about 12.15 to about 12.18. Support probably we'll see from the last Monday's lows, I think. When it filled this gap around 11.64. So I think there will be some support over there. So I think expecting some range bound movement. In terms of the weekly, I think it's still very strong. If you look at the weekly, price is still, despite the pullback, price is still maintaining a 10 SMA level. So as long as 11.95 here still maintains, I think we could still see price remaining quite strong. Yeah. So probably just kind of a range bound kind of movement for now, I think. Next one for WeHer. Yeah, for WeHer, I think price is quite is in the oversold region. So RSI now is below 30, it's around 28 for now. Currently it looks like after the sell down, it's moving into a bit more of a sideways kind of pattern. Sideways movement. Some support is holding from the previous horizontal levels around the 67, 68 cents level, which was this range consolidation we saw in the second half last year. So currently now is moving sideways. I think price will will recover if as long as it could break above today's highs. I think somewhere around 71 cents, which is like last Thursday there's also a test of 71 cents as well. So that if the price can close above this level, that will be above the 10 SMA level as well. Then we could potentially see some rebound towards the next key resistance. I think will be around 75 cents for a week. Yeah, for now I think it's just kind of probably quite sideways. Then if there's a breakout of 71 cents, then we could see a recovery in the share price. Okay, next one is Sembcorp Industries. Yeah, for Sembcorp Industries, I think overall, in terms of the weekly, I think it's still a bit weak for now. Overall, it's like still a trend of lower highs as well as lower lows generally. And then I will expect some resistance over here for now around 585, which was previous swing low support, and last week it tested there was some resistance over there. Afterwards, the next level was probably around 595. Yeah, so for now it might continue to do a bit of a range bound. I feel some support like 560 to 570. For the Lion OCBC Hang Seng Tech. Yeah, for the Hang Seng Tech, I think generally it's still pretty weak. Since the breakdown of some key levels, which was like over here at 88 cents, and afterwards price also broke below 85 cents, and then subsequently also 82 cents this level as well. So generally it's still a downwards trend, and then I think for now some resistance will be around like this 82 cents to about 83 cents area previous the recent support breakdown end of February, and then some short-term support around 79 cents overall. So I think still a downtrend for now. Yeah. The next one is on Eli Lilly and Company. Yeah, so for Eli Lilly, I think there's some recent slight weakness in terms of the price. I think generally has been trending down a little bit with slightly lower lows and lower highs. So I think generally could be following a bit of this trend descending wedge over here right now. So some support around here at 977, but generally I think resistance for now would be somewhere around like 1010 over here, which was this breakdown level at the start of March. Yeah, so I think price could continue to form a bit of lower highs, and then the next key support level for that would be, I think, around 954 next year, based on previous resistance. Yeah, so I think for now probably some sideways and perhaps some just a bit of a lower highs and lower lows still, as it continues to trend within this descending wedge. Next one is NVIDIA, which is the 2 times NVIDIA daily ETF. So for this, I think still quite generally still very range bound. Nothing much has happened. The key support to look at for this, I think, is still around the $74 mark, which is tested a few times. And if that breaks down, then we will see some weakness now. For now, I think it's still quite range bound. Generally resistance for now is at 83. 83 to 85 area. It is like around this level. So still just moving sideways. Then next one is the SOXL, which is the daily semiconductor bull 3 times. So for this, I think some slight weakness recently was once price broke below this uptrend support line, and then also this horizontal range level at 59.50. And then currently, last Monday, there was a retest of these swing lows at around 49.30. And then we saw a bit of a rebound. Over here. Some resistance was met at around the 10 MA level, 56.70. So I think for now, we could see some kind of range bound trading. Some support will be from the last week's swing low around 45 and then some resistance for now, I think probably be 54 to 50. So I think we'll probably see some sideways for now for the SOXL. Next one is on city developments. Okay, for city development, I think currently price close to the 100 SMA level. It's around 830 around there, so that might be some support. Below that, the next level I think is around $8 to 810 previous consolidation level. For now, I think still a bit weak for now since the breakdown of this uptrend channel. Price has seen more volume selling, and then just short term pullback over here for now. Resistance I think for now will be around like close to somewhere like $8.90 to $9. That will be the resistance. The next one is oil tech. So I think oil tech, I think the chart is looking good. So price previously over here, price managed to break out this 73 cents level, and then started to form some higher lows over here, around 70 cents, and then there was a breakout of this 80 cents level on high volume last week as well. So currently testing some resistance level at around this 90 cents to 91.5 cents area. So probably we could see some short-term pullback. But I think price for now will probably be supported around 82 cents and above. This previous resistance likely to turn into support. Then once it reconnect the 5 SMA, there will be a support as well. So I think if that, we could probably still see price continue this short-term momentum over here. The next resistance above that, I think, will be around 95 cents. For oil tech. The next one, CSE Global. So I think for CSE Global probably quite range bound for now. Generally, I think the range is between 122 to 137 over here. In terms of the weekly chart, I think still strong as it's maintaining the 10 SMA weekly. So that on the weekly, the support is around 120, 121, 10 SMA for now as well. So I will expect some kind of a range bound movement for now with some resistance around 128, 129 currently. And for CNMC Gold Mine, CNMC Gold Mine, I think some slight pullback recently, but in terms of the weekly, I think it's still pretty strong. Just a reconnect with the 5 SMA weekly. Currently now it's 168, 169. And on the daily chart, I think some short-term resistance probably will be around like 175, 176, which was like the horizontal support last week. And then there was a break below there on Friday. So I think any retest of that will be resistance in the short term, 175, 176. Then support is like now 160, 157 to 162. So probably kind of a range bound, I feel, in the short term. Okay, next question on China Aviation Oil. Yeah, for China Aviation Oil, generally I think is trading within this uptrend channel over here. So now I think it's a bit on the higher side. Retesting this the uptrend channel resistance area around 205, as well as we have this swing high resistance over here as well. So short term wise, I think we could see maybe some pullback. Yeah, and some support now is like 198, as well as around 193, I think, for CAO. Yeah, so I think we could see some short-term pullbacks, some consolidation over here. Yeah, but overall the uptrend I think is still remaining quite strong. Next question on Comfort Delgro. Yeah, so for Comfort, I think after the earnings, there was a breakdown of this 149 level. Subsequently, also price also last Monday broke below this 145 level. Currently seeing some resistance over there. So I think still be big for now. Resistance at 145 generally, which is also like the 10 SMA level as well. Then support is fine. It's currently finding at 142, this next horizontal level over here. Yeah, so I think for now it's still a bit weak unless you can get back above 145. But for now could be just moving a bit sideways between like 140 to 145. Yeah, then below that, the next key support level I think is around 136, 137, which was like the range lows in June last year. Next question's on Geo Energy Resources. I think for Geo Energy is quite strong. Since price broke last week, above this 45 cents level, there was a back test, and then which was finding support, and also price continued to trend higher as well. Also with significantly more volume recently as well. Yeah. So with that, I think also currently for now, I think still very strong. Some support for now if there's a pullback, probably around 52 cents previous high, and along the 5 SMA as well. So I think for Geo Energy is quite a strong short-term momentum now. Okay, for Pacific Radiance, I think price action wise it's still looking at some weakness since the price broke below some levels. Like start of March, it broke like 0.094, this horizontal support level, afterwards 0.086. So I think for now the short-term resistance is 0.086. In terms of some of the key supports for now will be the current lows like 0.077 and 0.074. I think that will be the short-term support level over here. So for now, I think it could be a bit sideways. I think for now. Okay, next for Marco Polo Marine, I think we could see some short-term pullback for the price. I think when price couldn't hold this 0.163 break level over here, and then afterwards we continue to see weakness in terms of the price where it's trending below the 5 SMA level. Yeah, so I think today also below this 0.147 level as well. So I think short term wise we could see a retest of this swing low at 0.141, and then next support level I think is 0.136, this level as well in beginning of December last year. Sorry. Yeah, so I think we could still see some little bit of a downside, perhaps test this 0.136 to 0.141 levels. Next one for Union Gas. Yeah, for Union Gas, I think today there's quite a bit of volume coming in. Yeah, testing this 41 cents level over here. So there could be some resistance over there. From the October highs last year. But I think some support could come in if we backtest this 39 cents to 40 cents area from here. So it looks like still a bit of a range over here, generally since August until now. Yeah, then 41 cents some reasons. After that is around 44 cents. Okay, next one for Pan United, I think overall it's still very strong. I think yeah, today there's quite a long lower wick over here, testing the 20 SMA level, 133, and then currently it's pulling back up to like 144. I think generally still very strong. Some resistance for now 151. So I think after the run up from 126, we could see a bit of a sideways consolidation perhaps. Yeah, but I think overall on the weekly, it still remains very strong. Now it's finding support from still continue to hold above the 5 SMA weekly 136 over here. So we could see some, I think sideways, maybe some support for now, maybe 138, 137, 138. The next one, Yangzijiang Shipbuilding. Yeah, for this, I think still some short-term pullback as price remains below the 5 SMA level, and then today also it's also below this 397 this horizontal level, which was like this swing high resistance. Then price was holding this level I think last week as support, and today there's a bit of a break below. So I think we could still see perhaps some short-term pullback. Maybe next key support is around 375, I think previous swing high over here. Yeah, and also currently below the 5 SMA weekly as well. So the next key support 370, 10 SMA weekly. Yeah, 375 I think there will be a stronger support where it hits. Yeah, so for now I think for price to regain some strength, I think it needs to break over 397 as well as the 5 SMA level currently. Now we could likely to see continue some pullback for now after the run up in the beginning of March. Okay, next question is on CATL. Yeah, for CATL, I think for now it's likely to be quite strong momentum. I think price managed to I think after the earnings it managed to break out this consolidation about 540, and then afterwards also made a new all-time high above 614 over here. So still strong momentum. Any pullback for now likely to find support above 614 this previous resistance, as well as along the 5 SMA. So I think generally still very strong over here. And then next one for BYD, I think for BYD, I think the price could do a bit of a recovery. So currently it's still in this range consolidation, key resistance at 103 over here, but price has been testing this level a few times. Then for recently, I think managed to price sort of like a double bottom over here at $90.40. And price has been holding a bit of a higher lows above this $94 level. So I think generally still a bit more positive. Yeah. So I think if you can sustain, if price can remain above, let's say 98, $99 over here, I think there could be a chance of a break above 103 for a bit of a recovery. Yeah, in this downtrend. Yeah. So some of the next key levels above, I think will be around uh 107 and as well as like 112, 113. My next one is Zijin Mining. So chart. Okay, for Zijin Mining, I think there's some probably some short-term weakness over here. So I think price is currently below this. There's this trendline support over here, and then some of the other price action is like some looks like a bit of a double top over here at 46. And then also yeah, generally quite weakness where currently trending below the 5 SMA level. So I think for now some resistance like is probably around 38 to $39 this area, which is also this horizontal support that it broke down. So short term wise, I think we could see some pullback, some continued pullback towards the previous resistance area of 34 to 36 for some support. Yeah. Okay, then there's a question on ultra green AI. Yeah, for ultra green AI, I think yeah, the price was over here, I think there's some weakness after the breakdown of 171 and then went down all the way towards this previous resistance at 143, 145 and then doing a bit of a rebound, right? So yeah, some resistance I think for now will be like this 158 level, and then afterwards subsequently likely to get around 164. Yeah, so probably we could see some sideways movement. I think for now, support generally I think should be around 147. Yeah. Okay, next one is a question on outlook and I'm sorry, TA for the three local banks. Yeah. So first out DBS, because of the TA, nothing. Yeah, after last week we test of this, then there will be a rebound. I think otherwise we'd like to see some kind of range consolidation. Near-term resistance likely to be around 56. Yeah, around $56 for now. And if you can hold these lows, I think the support will be around 54, $55. Yeah, then for UOB, I think after testing this resistance level previously 35.40, I think it's holding right here for now. So looks like some range consolidation as well. Generally I think 35.40, and then resistance likely to be around 36.50 to I think 36.80 around there. Yeah, so also quite range bound. then for OCBC, I think last Monday tested this $20.20 previous resistance level. There was a bit of rebound afterwards. Also quite range bound for now on. Some resistance I think will be for now, I think it's around $20.80 to $21. Yeah, so I think general for the three local banks after some retest of the previous resistance, I think during the sell down last Monday, I think sort of still quite range bound after a bit of a rebound. Then there's a question, what's the key reading for SanDisk? Is for SanDisk, I think generally it's still in the uptrend over here. And I think recently, I think it has done quite a long sideways consolidation since start of February. Then I think start of last week, I think it did a retest of this swing low support around 539, finding support over here and doing a rebound. So short-term wise, I think still quite strong recovery above the SMAs, like around 600, probably around 610, 620 over right now. I think there probably could be a uptrend continuation. I think after this consolidation period over here. So this is like a bit of a descending triangle, I think. And I think there could be a breakout of this trend line to actually retest the previous highs around here at 725. For SanDisk. On the weekly, I think also nice pullback towards the 10 SMA weekly and then a strong rebound from there. So overall, the uptrend is still pretty strong. Okay, I think it's about 1, so I think I will end the TA over here. I think there's still quite a bit of questions, so I'm unable to take all of them, but feel free to post in our Poems Tree community for your questions. So I'll just stop sharing my screen over here, and I think I will just end the session over here. So thanks everyone for all your questions and also joining today's morning call. And if you have any more questions, feel free to post in our Poems Tree community, and we hope to see you all again next week. And also feel free to join our Corporate Insights webinars, which is taking place the week following. So thanks everyone, and hope to see you all again. Bye bye. Have a great week ahead.